Maybe we should kick off now?
Yes.
Yeah. All right, great. Thank you very much. Well, good morning to you all. It looks like a beautiful day, at least in Nairobi today, and Eldoret as I can see it. Thank you very much for making the time to be here. Let me just start by a quick introduction to the session, where we're going to talk about resilience, technology. How have technology-led business models enabled or not business models in and across Africa, and resilience being a key word, particularly around the time of COVID. So, the idea is to make this session as interactive as possible. I believe the questions will be coming through written format. So please feel free to ask any questions whenever, and I'll take them up. But firstly, let me just start by introducing a very strong and distinguished panel of individuals across Africa. I'll start with Andreata Muforo. She's a partner with TLCom, based here in Nairobi. TLCom, for those of you who don't already know them, should know them. It's a venture fund based for investing in East and West Africa. And they've been doing some very interesting work across the agri chain, the education space, and the healthcare space. So we really look forward to talking with Andreata, who's been a partner that's invested in a number of these transactions over the last few years. Then I'd like to introduce Rebecca Mincy, who's the investment director with Acumen Capital Partners, again based here in Nairobi. Acumen Capital Partners is a reasonably recently formed partnership focused very much on the agriculture side. I look forward to hearing from Rebecca on how technology, and if technology, has been used in order to bring about some level of resilience in the different business models that we see across the agriculture value chain, and how they're benefiting from it, and looking at investing in that space. Moving on to the other side, a couple of entrepreneurs, starting with Isaac Hunja. He's the founding member of Sky Garden, based here in Nairobi. Isaac founded Sky Garden a number of years ago. Sky Garden's a leading e-commerce site, which allows and focuses very much on the micro merchants across Africa, and providing them with the infrastructure that enables resilience, and therefore enables some level of predictability and the ability for micro merchants to actually start addressing the digital market, which is growing. So welcome, Isaac. Thank you for being here. And then finally, but not least, Emilian. Emilian is in the middle of Eldoret. I see he's moved from his car to something more solid.
A clinic.
He's a clinic. Okay, so he's actually live at work. I guess making sure his investor TLCom sees the better part of him. So we look forward to talking and hearing from Emilian around how he's capturing digital or e-health in a way that enables distribution and enables a lot more of the clinics across the rural parts of Kenya. So, ladies and gentlemen, thank you very much for being on this panel. And then finally, myself, I'm a partner with Avishkar Capital, based here in Nairobi. Avishkar Capital, for those of you who know it, we're part of the Sankalp team, but also a significant investor in impact investing across financial services, agriculture, and essential services as well. So welcome, everybody. Let me just start, Emilian, with you, because I'm really curious on your business. I'd love you to just address a couple of things that you do in terms of what is your business and why did you decide to venture into this business, and how are you trying to address, or what is the problem that you're trying to address?
Sure, thanks, Ashley. So look, I've been in Africa for 10 years, and what I see very, very often is that while 70% of any clinical decisions require some kind of diagnostics, right? If we go to see a doctor, we always do, very often do, a small blood test or any other kind of diagnostics. There's still, 3 million people in sub-Saharan Africa and actually mid and low income countries dying because of lack of access to care. But there are 5 million people dying every year because of poor quality of healthcare. And that's exactly what I see. I'm here in Eldoret in a small facility. I've been seeing 7 yesterday. The same problem. There are plenty of small clinics. There are actually 15,000 of them in Kenya, but very few of them can offer anything more than just a malaria test. So none of them has any diagnostics capabilities. While again, 70% of the clinical decisions should be based on any kind of diagnostics. So what we do at Ilara Health, we try to solve this massive access to quality care and to quality diagnostics by bringing into Africa small, portable, high-tech diagnostic devices plugged into a phone or a tablet, so the kind of a next-gen version of the big old-fashioned diagnostic devices. We bring them here, we place them door to door in those small facilities like the one I'm here today, and we connect them with a technology platform to be able not only to understand the issues and the level of diseases targeting or covering individuals in those peri-urban areas, but also being able to communicate these diagnostic data back to the clinic and eventually back to the patient. And we are today in about 250 small medical facilities, most of them in the outskirts of Nairobi, Kisumu, Eldoret, Mombasa, and we're expanding into 1,000 towards the end of the year.
So Milian, is there any behavioral changes that you are expecting your consumer in this case is the practice itself, the clinical practice. So is there anything different that they were used to do before versus now? And therefore, is there any behavioral changes that's needed? Or is this simply a method of bringing in a much cheaper device that essentially does the same work?
Sure. No, that's a great question. And look, if we were to sit in an upper income area of Nairobi or sitting in any other city, in the developed world, we would go to a clinician and we'd get prescribed, a number of blood tests, and then or by the specialist, and we go to a lab and get the test done. What we've seen here, actually, what I see very, very often is that there is so little prescription of those diagnostics. So there is a lack of diagnostics. A blood test in Nairobi costs exactly as much as costs in London, New York, or Paris, or Cape Town. But there's also a reason why there's no diagnostic. There's a lack of prescriptions made in the public facilities, and there half of the healthcare in Kenya is public, half is private. So it's not just placing diagnostic devices and thinking that this can bring access to care and even bringing those tests, making those tests 3 times cheaper is not good enough. We also need to build awareness around certain tests, which we may think they're basic, and they can detect the basic diseases killing 50-60% of the people in this country. Diabetes, different cardiac diseases, a couple of cancers, but it's not that obvious because there is little understanding on the clinician side that those tests exist and should be prescribed, and therefore they don't prescribe them.
Rebecca, I'm just going to move to you slightly because it just reminded me a little bit around testing that's also required in the agricultural space, right? From a productivity perspective on land usage, etc. Are you seeing anything similar in your space around agriculture?
Absolutely. In fact, we look very closely for innovations when we make investments that are improving farmholder productivity overall, and in turn yields, in turn incomes. And so, for example, every business model that we invest in has to have a improved kind of lot in life for smallholder farmers, because we believe that improved productivity increases your income, which also contributes to your ability to absorb climate-related shocks. And so that is part and parcel of our investment thesis, and something that we do track over time with regard to our investments.
Got it. And are we seeing, or are you seeing many entrepreneurial businesses being set up in Africa addressing that issue?
Oh, sure. So I would say 10 years ago, it started as having just better seeds and high quality fertilizers and seeds. And that's definitely gotten better in terms of the availability and the financing of that. Some of the things that we do see is as exciting on the productivity front is water management in general. So for example, ARAF, we've invested in a solar irrigation company called Sun Culture, and our data is showing really strong productivity gains, even in spite of COVID, that we're pretty excited about for the smallholder farmers that actually subscribe to their pumps. And we're also seeing productivity gains with farmer training, whereby you either have some sort of demo day, you have some sort of agent that provides the farmer training, and or some sort of information push. We're seeing some improvements overall in farmer productivity as a result of that intervention as well. So yes.
Understood. Thank you. Thank you.
Mm-hmm.
So, Andreata, just coming to you on particularly, you guys have successfully, and congrats on making the investment with a million recently. What was it, what was the investment thesis that you have followed? And I'm just trying to bring in the commercial aspects because, we know TLCom, and I'm trying to understand how you or why you got excited by what a million's doing.
Great. Yes. So yes, we did recently invest in Elara. It was the end of last year, but a million is somebody we've known for many years. So I think I'll start more generally, and then I'll go more specifically into the Elara investment. When we look at investments, how is it that we think about investments and making an investment decision? So the three main questions that bucket of questions rather, that we want to answer when we're assessing an investment opportunity is one is around the market attractiveness. So is this an attractive market in terms of, is this a large growing market with good economics, opportunities for us to exit? Then we think about the company. Is this a good company from the sense of the business model? So yes, it's an attractive market, but does the company have the business model to be able to unlock that opportunity? And then is the team one that can execute on that business model? And then also, of course, we look within the ecosystem to see who else is doing this and how do they stack up against their competitors. And then finally, the last vertical is around the attractiveness of the investment for us as an investor in terms of the return we're looking to get from the opportunity. So if a company can check these three boxes, and of course it's a little bit deeper than what I've just described in 30 seconds, is if you can check those three boxes, then we would invest. So in reality, go ahead.
In reality, how long did that 30 seconds take in case of Elara?
It took about, I think, 3 to 4 months of engagement and speaking to different stakeholders. So in the case of Elara, I think Emilian has spoken quite a bit around kind of the market opportunity. What is the problem that they're solving and the solution that they're bringing to that? So healthcare, it's a very underserved market in Africa. So if you think about kind of the need and what are the solutions, and I think also for a long time, I've been in the market in this tech VC space for the last 10 years. So healthcare and education have been ones that have been quite hard to crack, but over time, many solutions are coming up that actually are viable and are creating, solutions that these healthcare businesses need. So I think in the case of the market, the market is very clear. That this is a large growing market. And if you think about diagnostics, the way we also think about Elara and diagnostic is that diagnostic is an entry into the clinic, right? Because there are many things that a clinic does, and when you bring diagnostics, you're providing an essential service that helps you build the relationship with the owners, and then you can also now look at other services that you can offer the clinics. So it's a service that one helps them do their work better as doctors and nurses, and also it's one that brings revenue to the clinics as well. So it's a great entry with a lot of alignment with the clinic. So that's something that we liked. We liked, of course, the use of technology and the fact that they're providing a solution that's affordable, because I think that's an important thing that you have to think about when you're investing in healthcare, because people can't pay, they don't have a lot of money to pay for some of these services you're providing. So the question is, how is the business model able to unlock and make sure that those services are made available in an affordable way for the end patient? So I think when you think about what Elara does in terms of the devices that they provide, it comes at a price point that the clinic can then serve their patients. And of course, the team, it's led by, a very strong team. Emilian is a strong entrepreneur who's been an entrepreneur before, and also done many other things in the investing space, together with his co-founders. So we felt and got the sense that, they're passionate about the problem. They have an ability to execute, they think quite thoroughly about the problem. And if anybody can try solve this problem, this is the team that we would back.
Thanks, Henrietta. Tell me one thing, either yourself or Emilian or Rebecca, in terms, when we talk about resilience, we're in the middle of COVID, or at least hopefully the other side of the middle of COVID. How would you say your business model, how resilient has it been? Was it designed to be resilient, or has it just been something that you found out to be resilient? That'd be great. And then just as an add-on question to that is, I'm also curious to understand from the consumer side, i.e. the end patient, has what Elara done or is doing, is it reducing the cost of medical care for that end patient in a way that's maybe or may not be resilient? So I'd love to get a sense.
So probably more like a general answer to this. I strongly believe that in markets and businesses which tackle with the basic needs of people, which is eating, healthcare, a bit of energy, moving from A to B, sending money from A to B, those are things which can be done and need to be done in any case. COVID, no COVID, war, no war, economic downturn. So those are the most resilient businesses. Now, healthcare is an interesting thing because, unlike in most developed parts of the world where healthcare is also their checkups, continuous checkups, monitoring, in most of the population here, the healthcare event is when someone really cannot do anything else. They try to take a medication at a chemist. They try to solve the problem by themselves, but they got to the point where it's very much about life or death. And that's when they go to see a clinic. And in most of the cases, it's too late, or it costs a lot of money, and then people go and try to find money. So how COVID has affected us, also the fact that COVID hit people stayed home because of the stigma, because of the lockdown. And we work with clinics, people didn't go to clinics anymore. So in the very beginning of COVID, we've seen a massive drop in patient flow, therefore a drop in utilization of the devices, therefore in drop of payments to us. But we also saw that this came back to levels before COVID very, very fast. Because I think people need to take care of themselves. They are sick, they need to seek care. And that's one of the basic things. And also, unlike in the Western world where, the crisis affected people with a positive investments, here is very much about day-to-day living. So someone who lost a bit of revenue because they couldn't sell fruits and veggies in the market, the first month, they got back to their revenue very, very fast. So it's those markets are very resilient in general. That's my thinking.
Yeah, and I think also when we are investing, just on the point of resilience, is our view is long-term, right? Because we're looking 7, 8, 9, 10 years down the line for our investment. We're long-term investors. So when we're assessing an opportunity, it's thinking about what is the usefulness of this opportunity several years down the line. So, and I agree with Emilian that some of the businesses that we're seeing on the continent now, it's really essential services. It's stuff that you would do anyway with or without COVID. So COVID is like a bump on the road, but it's a longer road. You're going to Mombasa, and then it's a bump somewhere along the way, but you still have a long journey ahead of you. So taking a long-term view and essential services. And I think also, another piece around resilience that we think about as investors is the fact that it's when you think about the team, I think then it becomes important, because change, it could be COVID or it could be something else, a terrorist attack. It could be, many things happen within our economies, devaluations. But it's also about, are you backing a team that has an ability to pivot, to adjust, to change their business model, so to think on their feet and be able to deal with the challenges that they're facing, because there will always be something that will show up.
That's a very good point. That's a very good point. On the topic of resilience, Rebecca, the talk around resilience in agriculture, there are countless articles written on it. To be honest with you, I still scratch my head around what does that mean. Sure. Could you enlighten at least me, if not some of the other members here?
Sure, happily. So I think resilience in agriculture means two things. There is the more general term, which means how quickly is the agriculture community able to rebound from things like COVID, for example, or an economic downturn. And as has already been mentioned, the agriculture sector, certainly in East Africa and as well in West Africa, has rebounded quite well. And it is actually, in some cases, has rebounded better than expected because of the disruption of other supply chains, global supply chains that have normally provided agriculture to those countries, now there is a local production push and a local production opportunity that has emerged as a result. And so, like Emilian says, people have to eat, and so what we are seeing as well is a bit of a change in consumer preferences. Maybe they want to switch from fresh milk to long life milk, but they're still consuming a lot of milk. And so if you double click, yes, there are some changes that are going on, but broadly speaking, we're seeing a lot of great rebound in terms of just a general sense of resilience. The other part of resilience that I think is probably used interchangeably with regard to agriculture is resilience to changes in climate. And as I mentioned earlier, this is where we spend a lot of our time and a lot of our focus thinking about how to make the value chains that we're investing in, the companies that we're investing in, resilient to changes in climate. And so we look at things like the distribution model, we look at farmer training, we look at crop insurance, we look at climate financing, broadly speaking, and a myriad of other criteria as we begin to make investments that we believe will help smallholder farmers, again, as Andreatta said, over the long term. The climate change conversation is not a year-to-year conversation. It really is one that requires you to look over the arc of a number of weather patterns over 7, 8, 9 years. And as such, we are really thinking about looking backward at changes in climate and weather patterns, but also creating products and services that are in line with the trends that we see happening and as they relate to smallholder farmers.
Thank you, Rebecca. Isaac, I'm struggling here because I can see food being very important. I can see medical care being very important. You are in the e-commerce space, albeit it seems to be the sexier part of the investing value chain, right? Not many people talk about education and healthcare, at least on the technology front right now. But e-commerce around what Sky Garden's doing, where is the resilience there, or what is the demand, or what are the drivers that you're seeing in your business? Why do people care?
Yeah, so
and I'd also love to just expand it a little bit into, has COVID been a very difficult period for you guys, or is it been very similar to what we're seeing with the US and European players such as Amazon and others, where they've actually seen an uplift in value or sales?
Yeah, I think for us, we definitely did see behavior change when we were hit with this pandemic, and various aspects of our model that were built for resilience did begin to shine, and these aspects included our deep penetration when it comes to our third-party logistics network that we've built, and also the ability for our e-commerce technologies to support small and large-sized players in the market. So because of that, that allowed us to really catch the fall for a lot of sellers that were more leaning towards a brick and mortar side of their model, and understanding that they had to rely on partners like us. So when it comes to the partnerships, when it comes to the relationships that we have been nurturing for the past few years with these sellers, some of whom were deep relationships, others we were still, just knocking at their doors, it's become a lot easier for us to work on partnerships that really bring forward their products to their customers because of our ability to have the last mile delivery to these customers. So when it comes to the ecosystem of our merchants and the sellers that we support, that has really been growing, and COVID has been a catalyst for this over the past year. When it comes to the consumer side of our business, in the early stages, we did see the panic buying, and we did see the huge surge in grocery and FMCG purchasing as customers were not going into the supermarkets and the other stores. And we also saw the behavior change with people setting up their houses for a work from home environment, and understanding that maybe they need a new couch because they've never been at home for this long, and all these different weird trends in people buying hair clippers because they can't go to the barber shop anymore. All these different trends that we didn't identify strategically before COVID, we began to see. However, the things that did affect us negatively were really on a macro level. When you look at sellers not having access to product that they used to import from China or Turkey or other markets. Also sellers not having access to product that already is in the country, might be stuck in customs or stuck in a store that they don't have access to in the early stages of the lockdown. And that really poured cement into our platform, and customers were seeing products that they thought they had access to, but in actuality on the ground, we didn't have access to these products. So I think our model is resilient in the fact that we have opened doors to many types of sellers in the market, and we're able to adapt, and we're very malleable to the situation that we're in. However, we are at the mercy to some macro activities in the market that can really force us to lose our footing sometimes.
Thanks, Isaac. So Isaac, just remind us, your typical customer, who is he or she, and how do you, what is it that you are doing for them that, I don't know, other marketplaces in the country don't, probably offer them the same solution?
Yeah, so when we looked at this market in our early days, before we wrote even a line of code, we identified that there was a lack of trust in e-commerce, a major lack of trust when it comes to the sellers that we were identifying as the gap in the market. And these are the small and medium-sized enterprises that don't have large stock, that don't have a brand in the marketplace, and have very limited cash flow as well. And we identified these sellers only being able to sell products on platforms that are not trusted by the end customer. We identified, of course, the lack of reliable logistics and last mile delivery for these sellers, trusted payments and seamless experience for users as they make payments to the platform, and just quick delivery, if you boil it all down to its bare minimum. And that's what we built for these sellers. We have software as a service that has payments, customer service, trust, and logistics out of the box for anyone that has something that is possible to put on the back of a bike or back of a truck. And with this, we've been able to decentralize our logistics in that we don't have a warehouse. And that's what differentiates us from a lot of platforms. When you do get an order, as a seller, we'll pick the product directly from the store and take it to the customer. And this allows you to really carry your brick and mortar experience onto an online platform, and still maintain your cash flow and still maintain your stock levels for online or offline customers.
Understood. And tell me a little bit about, just picking on the trend of both resilience. I get it, because people are staying at home, and therefore you're continuing to enable micro sellers to to transact. But what has been the reaction from the main retailers, right? Because essentially you're enabling micro merchants or small merchants to lift their game into the digital economy, which would otherwise, not be available to them. But that typically comes at a cost to somebody else. So what has been the reaction in the market, and how do you address some of these points?
Yeah, so it's been really interesting. Early years, we had all our focus on these small and medium-sized enterprises, and we were a little lower in the distribution channel. That's where we were operating. And we got the attention of people higher up, the sellers that you're mentioning, the bigger brands, more established players in the market, because we had built a platform that has ownership and has control and has visibility of how you sell online. And that was and still remains to be very attractive to these sellers. They're very archaic in their thinking. They're very, very slow in the way they move. And adapt to certain changes that are happening, especially on a digital scale. And they've identified us as a player that will develop around them. So the relationships that we have with the small and medium-sized sellers was really one for scale, where we were building for thousands. But when we speak to, speak across long tables in boardrooms to these bigger sellers, then the conversations begin to change as to dedicating resources to them to build customized solutions. And what we're always trying to find is the right intersection for what we can build that can help this one large brand, but will also help the larger market when it comes to the medium and smaller size sellers. So that's what's been happening. That's how the market has reacted. We've dealt with, for example, resellers of and distributors of smartphones, but we've been able to go higher up in that distribution channel and speak with the actual manufacturers and owners of the brand to have presence on our platform.
Understood. Thanks. Henrietta, I would like to just come back to you on, from an investor's perspective, what we have talked about right now pertaining to Kenya or East Africa. What are you seeing in West Africa? And Rebecca, even if you could come into this, because I know your fund covers both parts. I'm just trying to understand that, is this something that we're experiencing in Kenya? Or are you seeing other countries in Africa coming up with a level of innovation which is tech enabled to address what I generally see as just old problems being resolved or addressed, right? I mean, none of these are new problems, unless I've missed something here. But you're just enabling through enabling technology, resolving problems, and putting scale to it, right?
Yes. So our fund does operate across sub-Saharan Africa, and so we do see a lot of companies from across the continent. And in the end, though, the majority of the deal flow that we see is, Nigeria, Kenya, and South Africa is the bulk. These are the more developed ecosystems. But again, we still see, solutions from Uganda, from Ethiopia, from Cameroon, Ivory Coast as well. So it is the same in the sense that there's a tech enablement that's happening across different sectors. And what technology does is it allows, within the business models to a reduction in costs. It increases access of these services, and also increases efficiency when you think about now how the service is being delivered. So that's, I guess that's kind of the secret sauce that technology is bringing, and then allowing you to be able to scale more efficiently. So we do see the dynamics being quite similar. I think what in the beginning, what we were seeing in Kenya was a lot of it was riding around mobile M-Pesa and mobile money. So we saw a lot of the earlier companies really being built around M-Pesa. Every company had an at the end, at the beginning of its name. But over time, because payments do enable the accessibility of services, but over time this has really grown to be M-Pesa Plus. So we're seeing companies in, so say, commerce, healthcare, education also coming up. And then in West Africa, there isn't much around mobile money. So a lot of it, of course, they are still fintech players, and they have other ways and channels of sending cash, so the bank is more prevalent as a means and a method of sending cash. But we also do see companies in the same space. I think what typically happens is the fact that, when you think about Nigeria, it's a larger market, over 200 million people. So there's an attractiveness of Nigeria because of its size, and also just, I guess, the ability to also be able to go across the region as well. But we do, within our portfolio, it's almost 50-50 between Nigeria and Kenya. And we've seen our companies go, from Nigeria to Kenya, from Kenya to Nigeria, to Egypt, and to Southern Africa. So it is across. It's a theme that's prevalent across the continent.
Yeah, I don't know that I have much more to add. I totally agree that the technology and the innovation is certainly not limited to East Africa or Kenya. We're seeing it particularly in the agriculture space. We're seeing certainly tech as an enabler, where you're using databases and satellite data more efficiently to track farmers, to predict yields, to do just basic mapping of farmland and areas under cultivation, demand forecasting, etc. But we're also seeing an emergence of very specific farming technology. So think about precision farming, for example, that includes everything from mechanization to new and IoT-enabled greenhouses to soil testing and so on. And so we see again it's twofold on the tech side, both of which we are excited about. But both of which we, kind of scrutinize very heavily, particularly on the tech and farming, to make sure that it is really fit for purpose for what smallholder farmers need in this market at this time.
Thank you. Just a reminder to everybody that please post your questions on the chat box if you have any. We're open to questions. There's no limit, so you can ask anything you wish. Whilst everybody's thinking it through, I just wanted to ask both Isaac and Emilian on one thing that kind of I always wonder about, which is behavior change, right? And I kind of alluded to it in one of your questions earlier. To what extent do you both sense that some of these behavior changes are going to be permanent in nature versus temporary? Particularly in Africa, right? I mean, we're all so very used to going to markets, and that's almost kind of a day out for us, right? Going to the markets or the shopping mall or meeting people and friends. It's just part of the DNA for us. And I struggle at times to convince myself that what we've seen in the Western world, right? The behaviors of people in the Western world will not necessarily mimic what we will go through here. Do you want to have a shot at this? I mean, what is your sense, or what do you think?
Sure. So I can start. So indeed, Ashish, I think it's not it's not always the same thing. Like telemedicine has taken off a lot in the Western world in the past 10 months. Is that happening here? Not really, and definitely not in setups or settings where people do not pay for consultation. So there always need to be a business model behind the trend. Doesn't mean that if the trend happens in Europe or the US, will come here immediately in the same shape. There's a different shape. So what we've seen here is that telemedicine hasn't taken off in the same way it happened in the Western world, but there are bits and pieces of it in the different shapes and forms which is taking off, such as the B2B telemedicine, where we place a device in one of those clinics here, where there is no specialist, there is no doctor, there is just a nurse, but the nurse uses that device, and we have a remote clinician or remote sonographer performing the test from the other side of the country, from Nairobi, from our office. And that's a different way the same trend is happening here.
Interesting. Isaac, anything to add?
Yeah, you're completely right in your concern that these changes that we're seeing are not going to be permanent, and I tend to believe so as well. And I think for companies like ours and for other digital players that have seen a change in behavior that benefits them, we also have to plan for how we're going to move with the customers that are temporary, quote unquote, in that sense. The new customers that we've acquired that will eventually revert back to their old ways of transacting. How can we adapt our model to move with them? Because we have their trust now. They understand what we have to offer in the market. We just need to identify what needs exist in their old ways of transacting that our model can address. So this for us looks as assisted e-commerce, looks at offline, turning offline transactions into online transactions for the sellers that will be speaking face to face to their customers, so on and so forth. Just identifying all these different opportunities for the new customers that we now have within our stable that might not be here for the long haul if we do remain completely online.
Interesting. I was speaking to my wife the other day, Isaac, just a little bit off tone. And I was trying to explain to her all this stuff about artificial intelligence on the internet, how predictive, all these online shopping channels will go, blah, 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 blah. I went on for 15 minutes, to which she just replied that my mama mboga, these are women who come and sell vegetables to us for the last 20 years, the same lady. She goes, she's been doing this for me for the last 20 years. She knows exactly what I like, how many kilos I need, and which vegetable I need, which day of the week. So I don't know what you're solving for me, right? So
she doesn't need a Facebook pixel. She doesn't need you to download an app.
No.
Yeah,
and she gets a free 5-minute conversation.
Exactly.
So Henrietta, again, one key theme that's coming through is around valuations, right? There has been a lot of talk about hyped up valuations. We've seen valuations on some of the businesses that have recently closed. How are you as a fund, and same with Rebecca, how are you guys getting comfortable with that dynamic today? And obviously this is going to be in opposition to, or different to, where Isaac and Emilian are going to come from as founders. And how are you trying to bridge this gap, number one? And if you could just expand a little bit around that from the continent's perspective, around how you're seeing valuations evolve in West versus East versus South, where obviously the depth of markets may be a little bit different.
Sure. So I think, maybe I can start from how we think about valuations more broadly, and then maybe we can go specifically into what's happening in the market. So the way we think about valuations is first to think about the business itself. So you're looking at the company and where this company can be a couple of years down the line, so say 4 or 5 years down the line. So different from private equity, where there's EBITDA to multiply, there's, sometimes there's no revenue to multiply, right? Depending on how early one invests within the venture capital life cycle. So we think we take time, ourselves together with the entrepreneur to get a sense of when this becomes big, like how big can this become, so of course, quite a lot of thinking as well as assumptions that you put into that, but I think it's important. So we think about, okay, this business a couple of years down the line, this is what it could look like, and then think about what are the ingredients that are needed to make sure for the business to get to this stage. How realistic is it? What resources do you need in terms of the capital that you're raising? And then you also look at the stage that the business is at, right? Because this also informs your return expectation as an investor. If you're coming in at a seed level, so you're expecting, more than 20x your return. If you're coming at Series A, more than 10x your return. If it's B or C, where the company now, Series A or Series B or C, where the company is now, a bit more mature, And now it's just really looking to scale and grow. So you're looking at maybe 5 to 7x your return. So with that in mind, then you come up with a valuation. So we say this is precisely wrong, but vaguely right, as you can imagine. And of course, also when we're thinking down the line, so the question is, what could this business be valued down the line? There you'll have a business that has revenue, that has an EBITDA, and then you use the multiples in the market around when you're thinking about when I exit this business, who can I sell it to, and what are the going multiples at that? So and the return should compensate for where the business is, right? So that's how we think about valuations. And then when you think about kind of the markets, and I think there is some talk about, you know, valuations being very high. I think it honestly depends company to company. I wouldn't completely generalize, because I think there are some companies that are very popular, that are PR darlings or investor darlings, or you know, they're just, I guess, maybe in a space or the entrepreneurs have an attraction where there are many investors that are looking at the deal, in which case there is a higher chance that it can become, you know, significantly overvalued. And I think sometimes that becomes an issue if you're an investor who's flying in and flying out and are only able to see the companies that you read on the news. There are companies that are within our ecosystems, but they don't make it into all the news pieces. So I think, you know, if you're grounded, if you're on the ground and you're able to see more companies within the ecosystem, I think then you can be more thoughtful about the valuations. And like I was saying this in the beginning, like when we're thinking about an investment, we ask ourselves, is this an attractive market? Is this a strong company, and is this a good investment? And part of, is this a good investment, is around valuation, right? And the return that would get out of that.
And what sort of returns do you expect typically, or when mentally, you know, when you're doing a Series A, Series B, what sort of returns do you try and model yourselves for, if things were to work out?
Sure. So for Series A, it's the 10x, so cash on cash return. You know, 5, 6, 7 years down the line, looking to make 10x our money. And, you know, Series B, C, about 5 to 7x. If it's more, that's even better. Seed, you know, it's north of, you know, 15, 20 times. As kind of so going into an investment, we need to believe that if everything works, this is the type of return that we would get. And of course, that's why you also have a portfolio, because in venture capital, you have, you know, a section of your companies that will not return capital. Some will do okay, and some will do extremely well. So in the end, you have a, you know, maybe a 3 to 5x return on the entire fund.
Thank you. Emilian, you better cover Eldoret, Kiambu, Kisumu, and Kakamega today, because you've got a lot to cover.
And Kitale, just going to Kitale soon.
Yes. Thanks. Rebecca, do you want to add anything to that?
Sure, I'll just add a little bit. You know, we actually opened our doors for investing in October or September, excuse me, of 2019. And so, of course, the pandemic hit in February-ish. And so we have actually, you know, I guess I won't say benefited, but we haven't seen the spike in valuations that we had seen probably pre-COVID. And so the need to bridge the gap between, you know, founder expectations and investor willingness has been pretty small, thankfully. And so it just, you know, for now, you know, at least in East and West Africa, for us, for the companies that we're looking at, which, to be clear, are usually Series A, sometimes pre-A. It just hasn't been as much of an issue, but I would expect, as more investor appetite continues to bring financing into these markets, that the valuation conversations, you know, could be more interesting in, you know, next year, certainly, and the year after companies have rebounded, after they pivoted, after they've kind of done a self-correction as a result of the lessons learned from the pandemic.
So I have a question here from Cheryl to the panel. saying, hi, everybody, fantastic insights. My question is on the experience on how MNCs or SME ecosystems are evolving on the continent and perhaps accelerated during COVID relief. Any views, thoughts? It's on the chat box for those of you who are live on Zoom right now.
So maybe I'll give it a shot. What we've seen in the medical merchants, so I call those small medical facilities medical merchants because they sell a service. It's a lot of resilience. It's a lot of, they've tried the nurse entrepreneurs running those clinics have tried to find innovative ways to be open, to keep open, to still bring patients in, to still make money, because they need to make money by the end of the month to pay their rent and to pay their people and to still survive. So I've seen a lot of innovation in the past 10 months. And finally, I think the innovation comes in periods of crisis, right? Innovations came in the Second World War, came in the Cold War, comes when there is a crisis, and people are pushed actually to come with interesting, innovative ideas.
No, I would agree with that. I think, unfortunately, war tends to create a lot of innovation, as does crises such as these. I just wish we were innovative all the time, right? But that pace of innovation, Emilian, if you've seen or experienced over the last decade by decade, the innovation rates are increasing exponentially from both medical fields, business model shifts. What is really pleasing, and from what I hear at this event right now, is that what I felt Africa was missing out 10 years ago or 5 years ago, we are playing a bit of a catch up, but we are certainly moving fast in terms of business model shifts and technology-enabled shifts, which are addressing market issues, right? I don't know, Isaac, do you have anything else, or Rebecca or Andreata, anything else that you would like to add to that question?
I think one of the things that about the ecosystem is that the pandemic has exposed some already hard truths, and I'm thinking namely about the credit markets. The credit markets they were inadequate for the credit needs of SMEs, be it working capital or some other longer term well-priced debt. It was inadequate before, and I think that for those SMEs who are seeking credit, when COVID happened, and now that COVID is continuing its course, there is a real difficulty in securing the necessary debt that is needed. So it just kind of, I think what the pandemic did is it just really laid even more bare some challenges that were already there. And I don't know that the ecosystem around credit and financing has really risen to the occasion. There are some bright spots for sure. At my sister fund, Acumen, they raised a sizable facility just to provide, short-term debt financing, and in some cases even grant money to just shore up companies in the middle of the pandemic. It was meant to be a surge capacity initiative, not a long-term one, but it really speaks to, I think, some of the challenges in the credit markets that are quite pervasive for SMEs, not just in agriculture either.
Interesting. And would that change if we were to include multinationals into the equation? Are you seeing any shift?
Yeah, I mean, it would change it a little bit, but really not materially, Ashish. Some of the multinationals have absolutely come in and provided, well priced and appropriately structured financing, but they're few and far between, first of all, and second of all, they just take a really long time. So it may take you, 4 or 6 months to be able to secure that financing that you actually may need for your business, which, time is so precious when you're dealing with, certainly with a pandemic, but also just the day-to-day running of a business. You don't always have 4 to 6 months to go through, multinational review processes, diligence processes, et cetera, et cetera. So the local credit markets really seized. And even some of the players who are a part of the ecosystem for SMEs, they were pencils down until they could get a better sense of what was going on. And I think, it's only the kind of the character, if you will, of a handful of credit providers that really stepped up during this time period. But I think the majority of them basically said, we want to, and to which is what they should do. They're really concerned about the quality of their overall portfolio. And so they stopped making loans available until things settled a bit, which, perhaps is certainly good for them, but not necessarily good for SMEs.
Interesting. If I can just pick on that, Rebecca and Andreetta, just from an investor's perspective, one of the observations that we've had in certain industries which are predominantly brick and mortar, tech enablement is essentially looked at as a way to allow them to scale, right? How have you guys thought about it? I mean, are you, I guess, Rebecca, you see a little more, than maybe Andreetta does. But in terms of, let me give you an example. Microfinance, right? Microfinance can become significantly tech-enabled, but there's still a big story around ensuring that there are physical presence on ground simply because of the way collection and education happens to the typical borrower. What are your thoughts around those businesses in terms of scalability? Do you put a different metrics on valuation for them vis-a-vis pure tech businesses? And also, how do you gauge that? Because on one hand, it's a pure tech versus brick and mortar, but on the other hand, there is a significantly higher risk profile to a pure tech business versus a tech-enabled business, which actually has some level of customer interface.
Sure, happy to start. So just really quickly, just in terms of valuation, because everyone likes to talk about valuation, we tend to do a blended valuation when we have companies that are significantly tech-enabled and also have a brick and mortar component. So it's just a blend of kind of the trends and the velocity, if you will, of one sector and what we can.
Have we lost Rebecca, or have I lost you all? Okay.
Sorry, I hope you've heard me. So it's
could
neither.
Could you rewind 30 seconds or 15 seconds, please?
Of course, sorry. So I was just starting with the easier question, which is around valuation. And essentially what I was saying was that it's a blended valuation, that it's neither purely technology, nor is it purely brick and mortar. And that valuation is meant to.
Interesting, she cut off at the same point, right?
I think I can.
Please go ahead. Yeah.
I can speak. Okay. Rebecca, are you back?
I'm not sure if I'm back. I don't know if you can hear me. I'll wait and see if my connection stabilizes.
Okay, sure. I think, it's an interesting question, because I think what we see with many of the businesses that we invest in is that there is typically some physical component to it, unless it's a pure, we have some companies that are pure software companies. But the tech-enabled businesses do have, some physical component, some offline component to them for it to work, which is to your point, Ashish, earlier on the question of e-commerce and how, it's really ballooned in the West, but you may not see the same acceleration here on the continent. So, I mean, I think the way we think about the valuation, it's around the matrix and the KPIs, right? Because is it a valuation around, what is given your model, what is the revenue a couple of years down the line? So it's around, given your model, what is your ability to be able to scale this business and to be able to get to the revenue model, to the revenue that you're projecting. So I think it's, just by the nature of these businesses, some do need both components for it to work. And over time, you could probably shift to the online component only, but I think there's still an offline element in some of the businesses.
Agree. Rebecca, I don't know if you're back and if you want to add anything else.
Yeah, I'll try again.
Yeah.
How is this?
Okay.
Thumbs up, thumbs down?
Good.
Okay,
Thumbs
great.
up.
So in a nutshell, we're seeing some really exciting innovations around companies that are really starting with an online platform or starting with technology. Maybe it's a networking group, maybe it's a crowd, knowledge information sharing platform, and they are using that platform to be able to direct traffic, to direct customers to bricks and mortar locations. So obviously in our space, in the ag space, being able to say I have a platform of 40,000 farmers that are talking to each other about what works and what doesn't, I can basically push a discount or push information out to these farmers and say, if you want this particular product that just so happens to coincide with the rains that are coming, the locusts that are coming, etc., you can find these products You can place an order now, and or you can find these products at your nearby agro dealer. And then based upon that kind of network effect, if you will, business models and revenue models are being developed off of that. Because I think that what we found challenging on the investor side, we're not tech investors in and of itself, but we found some of the revenue models that are based purely on ag tech companies to be difficult to stress test. The SaaS models are super challenging, still have some time to go before they really flesh out at scale. And so we're really looking for models that build upon kind of the best of both, you know, what you get from having a digital presence and also being able to use that to leverage a more bricks and mortar presence is what we're really excited about. Hope that came through.
It did 100%. Thank you. Thank you. Isaac, just a point here for you from Kabuki. She runs Scrumptious Eats, a health and wellness manufacturing business. If you could, you know, once you're on your chat, it's there. And I'm part of a 70 to 100 micro and small women business. And we have noticed our digital sales have increased during COVID. I think there is an even more, there are even more opportunities for greater sales if we work collaboratively on a cost-effective distribution model. The brands are local and I think great quality. We could help scale these brands and contribute more to Buy Kenyan. Isaac, how can you collectively work with you? Chats are difficult. Sorry. So how she would love, so basically 70 to 100 micro food manufacturers, branded Kenyan produce. They'd love to work with you.
Really, really happy to hear. It's always great to find new business from a panel discussion. But I think this is really down our alley because we have a strong made in Kenya avenue for our sellers, and we put a lot of support on them. And finding communities like this is really what we like to see. So we have a team of engagement managers that deal with getting sellers onto the platform and helping them succeed by uploading the right type of products and putting in the right promotional tools in place for them to be able to further expand their sales in the platform. So it's as easy as just shooting me your email address. You can send it to me privately here on chat, and we can pick up this discussion after. I've just gone into their website and it looks fantastic. It looks like a program we would be happy to support.
Thanks, Isaac. One question, Henrietta, that's been asked, which perhaps you can enlighten us, and Rebecca, given that you've just recently, any views on how venture capital space has been impacted because of the pandemic? And maybe you can broaden it a little bit around, people forget that venture capital firms themselves have to raise capital as well, right? So it's the entire ecosystem from raising the capital, finding the deals, deploying it, getting the money back, etc. And how are you seeing the evolution in Africa, and particularly if you've got any concerns or you feel we're at a great time?
Sure. So I think, you know, one way, so we have been impacted both positively and negatively. I can start maybe on the positive side. I think we've at least for us as a firm, we've started to receive more interest around tech businesses, because I think the pandemic has kind of brought a narrative around, you know, digitization, acceleration, all these other buzzwords that have been said. So I think suddenly there's an interest of venture capital and tech investing. So I think that's been a positive, and I think also, even when you look at the resilience of our portfolios, of our tech businesses, like none of the revenues went down. It's either remained flat or it grew not to the level that they expected. So I think there's been a positive in that respect. I think it's also impacted the way we work, because, you know, typically it's a relationship game when you're interacting with founders or even with our investors. And there was a lot of FaceTime before, but now, you know, FaceTime can't really happen. So just also been a change around how we interact with, how investors interact with entrepreneurs. I think for the local funds like ourselves, we have an office here in Nairobi as well as in Lagos, we're still able to meet entrepreneurs, we're still able to do due diligence. So that's proven to be a real benefit. But I think for investors that are, in Europe, in Silicon Valley, in China, it's a little bit harder for them to do investments. And what many of them have, because they can't fly to have the engagements. So what many of them have been doing is relying on locally based funds and then following on those raises. I think even when you look at like the amount of capital that was raised in 2020 versus 2019, there was a decline, right? Depending on, no matter which report you look, because there are like 4 different numbers out there, but there was still a marked a decline, not gigantic, but it's been going up year on year. So there has been an impact around, I guess investors stopping and pausing and assessing what's happening, how is this impacting my existing portfolio before I start looking at investments, before I start looking at new investments. But I think, going into 2021, I think there's a bit of a normalization that's coming with the pandemic. It's been a year now, yeah. So people are now starting to live with it. But yes, I think the locally based ones have been able to manage okay. I think also for the fundraising of VC funds, that's also been a challenge. I know last year of 2 that stopped fundraising because they couldn't travel anymore. It's already difficult to fundraise. I think sometimes entrepreneurs think we have it easy because we're the ones investing, but we too have to fundraise. And so we sympathize and empathize with you, Isaac and Emilian. So I think there has been an impact around funds that we're raising and not being able to raise and pushing that cycle even longer. So I think the amount of capital dedicated to Africa, I think, was impacted in that respect.
Yeah, I would agree. Hope you can hear me okay. So similarly, fundraising it's a challenge for everyone, for entrepreneurs as well as for investors. And we just saw fundraising slow down, meaning that we may have had some momentum in terms of fundraising, or our companies may have had some momentum in fundraising. And then that momentum was completely kind of wiped away. In some cases, money was diverted to very, very specific COVID-related initiatives. And so then, that was no longer available. And I think for our companies, we did see some of their advanced conversations actually just stop until investors felt like they understood or had a better grasp of what was going on. So what that means is that a company that maybe they were trying to raise $5 million, they only raised $3 million, which means they're going to be going out to the market sooner than they had expected, which has all sorts of implications for dilution and so on and so forth. So that was kind of a negative, I think, that came from it. And then in a bit of a twisted positive, I would say that the fragile or more fragile companies didn't make it through the pandemic. And so what we have now is more of a battle-tested set of entrepreneurs with the ability to pivot, with the ability to really figure out how to continue to sustain their growth, figure out the right partnerships, et cetera, et cetera. And so I think, again, it's a bit of a twisted positive that's come out of it, but I think the cream has really risen to the top as a result of the pandemic. And so as an investor, I feel like we're really working with, the best of the best, and we're talking to the best of the best and the battle tested, which is really what being an entrepreneur is all about. If it's not a pandemic, it's a regulatory issue, it's always something. And to be able to speak to and work with entrepreneurs who have kind of managed the twists and turns of the last 18 months, I think is really well aligned for the types of entrepreneurs that we're interested in investing in.
Yeah, that point is actually quite an important point that Rebecca raises. I agree that, even within the companies, I think companies, even the ones who made it through, had to make very difficult choices. So I think entrepreneurs were also strengthened through the pandemic because you're trying to do the same or more with less resources. So how do you think about that? Making tough decisions about whether you had to lay off staff, whether you have to stop an expansion. So really kind of make those tough decisions. So I do agree that kind of the strength and the quality of the entrepreneurs that were able to manage through it, will be much stronger. I think as an ecosystem we've grown because of that.
Yeah, that resonates with me. I mean, the quality of entrepreneurs has really shifted positively in the last decade that I've been investing. The area that I'm still struggling with as an investor is, unlike Europe, US, or many parts of Asia, where the density of investors is quite high, and therefore you have a sufficient amount of follow-on capital that comes through. So just to give you an example, you've put in X million dollars into Elara capital, but hopefully in the next round you want X times $2 million of capital going into those businesses. I'm not yet sure that ecosystem has developed enough or quick enough for us to kind of ensure that there's sufficient follow through or follow on funding coming through. Is that something is that just my view, or do you find that there is an issue in that and the way you think about it?
Yeah, no, I completely agree. Where we see now we see a lot more initiatives around kind of seed, early stage, angel, checks of above 500,000, or rather below 500,000. As an entrepreneur, you can speak to many people and hopefully be able to raise there. But as you're now growing and you're scaling and you need 5 million, 10 million, 15 million, the number of entrepreneurs the number of funds on the continent that can support you with that is much less. Like when our companies are scaling and raising Series B or C, there are about 3 or 4 investors on the continent that you can speak to, and then you have to go out. You have to go to Silicon Valley, you have to go to Europe and other regions to look for that type of capital, because it's just not here on the continent. Usually the challenge also is you're too small for private equity funds, or you're not making profits yet for private equity funds because you're still growing. So there's a lot of private equity money in Africa, but it's not suited for the type of companies that we would have backed. So we do set aside capital for follow-on funding, but it can't just be our capital. We also need to look for other investors to come along.
Yeah, that's right. We see more syndications or consortiums here of investors who can put in anywhere from 3, 4, 5, 6, 7 million for a larger round of 15. We recently talked to a company who wanted a single investor for their $15 million raise, and we're like, that's outside of our ability. But if you decide to walk that back a little bit and have a consortium, let us know. So it is, I think, Andretta, you're right. It is a bit of a gap in the market that for the moment, well-funded VCs can fill, but there is an opportunity. And hopefully, your point is that, some of these companies are still EBITDA negative. Hopefully with, the type of capital that we're providing, we can really, through governance, push companies towards becoming more attractive to Series B, Series C, Series D investment, so that capital, the bigger ticket capital can, they're well positioned to secure that bigger ticket capital rather than just relying on consortiums.
Great, thanks, Rebecca. Emilian, do you want to add anything to that from a entrepreneur's perspective who's just recently been, whipped for fundraising?
No, totally in line with what Andrea and Rebecca said. So there's as much as there is a lot of capital out there for smaller rounds and a lot of angel investors, there's a lack in mid stage to growth stage. I also think that the market is still developing. There's a disproportional amount of capital versus great startups. I think, as Rebecca said, COVID had an interesting impact into kind of identifying the resilient entrepreneurs, the resilient startups which survive and even thrive through the crisis. But I also think that fundraising is not a one shot. It may take 3 months or 6 months between the kind of the discussions and the term sheet. But fundraising is a long relationship. It's a marriage in which an investor or a consortium of investors and an entrepreneur get into, and this takes trust, building relationship over long term, observing from an investor, observing the entrepreneur over time, over one or multiple ventures, and making a decision. So I think the market is evolving, is going into the right direction. We see the VC, you know, that there was a small dip in the VC investment last year, is normal, but I see Africa doubling every year in VC money. So I think we're going into the right direction.
So guys, we're coming towards the end. I just wondered if you guys had any closing comments, or if there are any burning questions, please feel free to write them in. But any closing thoughts on our discussions today, particularly emphasizing on resilience, tech enablement, that you wish to add?
I would just add one thing, is that one of what I've seen, during crisis, people get together and closer together, and then they try to work together. And partnerships are even more important now than they were. And we see actually in Lara how important it is actually, for example, to partner with insurance companies and pharma companies to bring payers in a health world where there's no payer or there's only 2% insured company. So partnerships are super important, making sure that entrepreneurs take care and ventures take care of their clients, B2B or B2C, even more into the B2B world. Solving their problems even over and above the basics of the business model, and making sure that they build a long-term relationship with those clients.
Sure. I mean, I think I guess one thing to add is that I think I do agree that our ecosystem is growing and it's maturing, and it's very positive to see, and it's quite exciting. And we definitely celebrate the entrepreneurs, because we wouldn't exist without the entrepreneurs. And I think even things like the pandemic, while they were very difficult, I think were also an opportunity to learn. And I think what entrepreneurs do most is to solve problems, right? So just another opportunity for them to solve problems. And I think as we saw also in the kind of the gaps in terms of in the US, there were trillions and trillions of dollars of cash that was given to businesses and to individuals as social safety nets. We didn't see any of that happening on the continent, which is the more reason why we need entrepreneurs, why we need the private sector to develop, because the government is not coming, they don't have the resources. So just I guess to encourage any entrepreneurs in the panel to continue working and solving some of these problems, which are actually fundamentally opportunities.
Yeah, and the only thing I would add is that part of our and at Acumen, our roots are in basically nonprofit investing. We raise philanthropy and invest. I'm on the for-profit side of investing, but the goal at Acumen has always been to bring in commercial capital to solve these social issues. And so we need entrepreneurs who are great at solving problems with an eye towards commercial viability to continue to do what they do best. And what we're seeing is that if you can balance this, commercial eye with solving the day-to-day issues and also kind of the macro issues, then you really have an attractive investment target for commercial capital, because there's not enough philanthropy, there's not enough government money out there. We really need commercial capital to come in and really continue to play the catalytic role that it can play. So that would be my kind of final thought.
Rebecca, thank you very much. Andreata, Isaac, and Emilian, thank you all for being so supportive and being part of this panel. At least for me, it was incredibly informative. I really enjoyed it. And I hope the rest of the audience did as well.